Welcome back to the deep dive. So I want you to start today by imagining a toll booth,
Okay.
but not just any toll booth. I want you to picture one that sits right in the middle of the global economy. Every time a barrel of oil moves across the ocean,
Damn.
every time a bank tries to hedge risk against a currency crash,
Ching.
every time a homeowner finally decides it's time to refinance that mortgage.
Ching. That is a very, very lucrative image you're painting. And you know what? It's pretty accurate.
That is the whole vibe for today. We are looking at the company that basically owns those toll booths, Intercontinental Exchange, or ICE.
Right.
And we're doing this now because they just dropped their full year 2025 earnings on February 5th. And honestly, the numbers suggest the toll booth business is absolutely booming.
Booming is probably the right word. We're looking at their 20th consecutive year of record revenues. I want to pause on that for just a second because it's so easy to just gloss over. 20 years. I mean, that spans the 2008 financial crash, the COVID pandemic, that huge inflation spike, all the geopolitical chaos of the last few years. And through all of that, they've hit a record every single year.
And that is exactly what I want to figure out today, because on paper, financial infrastructure sounds so dry, it sounds like plumbing.
Yeah.
But they have this concept they call the all-weather business model. I just want to know how the plumbing works when the weather gets really stormy.
And that is the perfect framing. Because ICE isn't just one business, it's a collection of businesses that are, well, they're designed to counterbalance each other. When one zigs, the other zags.
So let's just look at the scoreboard first. Full-year net revenues hit a record $9.9 billion. That's up 6%.
And adjusted earnings per share, that reached $6.95, up 14%. The market definitely liked it.
Right. But our mission isn't just to stare at the stock price. We need to unpack the three main engines driving this whole thing. The energy markets, the data business, which has a really weird new partnership I want to ask you about,
Oh, yeah.
and the mortgage business, which might finally be waking up.
And we absolutely have to talk about the future bets they're making, on AI and tokenization. Because that's where the strategy shifts from just running the pipes to actually changing how the water flows.
Okay, let's start in the engine room then, the energy complex. This is the part of the business that deals with oil, gas, commodities. The numbers here were strong.
Very strong. Exchange net revenue was up 9% in Q4. Brent crude volumes up 11%.
But I want to understand the why. Management threw around a phrase that really caught my ear: acts of God and acts of man.
It's a dramatic way to put it, but it's
Accurate.
it's accurate. In the commodities world, volatility is the product. And that volatility, it comes from two places. Acts of God are weather events.
Hurricanes, freezing winters, heat waves.
Things that stress the power grid. We had plenty of that in 2025.
We certainly did.
But the acts of man, that's where things get really complex. This is geopolitics, sanctions, wars, trade policy changes. And this is where ICE makes its money on the uncertainty.
Okay, let's dig into a specific example they gave on the call because I really want to trace the logic here. They mentioned India agreeing to stop importing Russian crude oil.
Right.
On the surface, that's a political headline. How does a political decision in New Delhi turn into profit for a company in Atlanta? Connect those dots for me.
It all comes down to the complexity of the supply chain. So when trade routes are stable, let's say ship A goes from Russia to India every single month, trading is boring.
Predictable.
It's predictable. The volume of trading is pretty low because everyone knows the price and the schedule.
Right. Nobody needs to buy insurance for a drive to the grocery store on a sunny day.
Exactly. But when India says no more Russian oil, suddenly those Indian refineries have to scramble. They have to source crude from somewhere else.
Probably the Middle East or the U.S.
Right. So the supply chain gets messy. Ships have to travel longer distances. Contracts have to be broken and rewritten.
Delivery times get all messed up.
Precisely. And when things are uncertain, prices fluctuate wildly. Now, if you're an airline or a logistics company or a manufacturer, you just cannot afford for your fuel costs to double overnight.
You have a budget to keep, so what do?
You hedge. You buy a contract to lock in your price.
Ah, bingo.
You run to the market to buy insurance on that price. You buy a futures contract. And the marketplace where that insurance is sold.
That's ICE.
That's ICE. Those U.S. and Middle Eastern grades of oil are priced off ICE benchmarks like Brent crude or ICE Dubai.
So the geopolitical chaos literally drives customers right into their arms to manage risk.
It's a flight to quality. When the world gets scary, you want to trade on the biggest, most liquid market you can find because you know you can get in and out of your position.
And that explains the volume spike.
It does. They noted that TTF natural gas volumes, and that's the global gas benchmark, were up 21% in 2025. That is a massive, massive jump for a mature market.
And it sounds like that momentum isn't slowing down at all. They mentioned January 2026 was a record month for energy trading, average daily volume up 27%.
Which just signals that the market expects 2026 to be just as volatile, if not more so, than 2025 was.
So Engine 1, the energy exchange, is just firing on all cylinders because the world is a mess. Let's pivot to Engine 2, the data.
The fixed income and data services segment.
Right. This is the shift from just, trading the stuff to selling the data about the stuff.
And it's a great business to be in. Recurring revenue here hit a record $507 million in Q4.
But I have to talk about this partnership they announced, because I actually had to read it twice.
I know the one you mean.
ICE, this super suit-and-tie, buttoned-up financial fortress, is partnering with Reddit, the home of memes, cat videos, and endless internet arguments.
It sounds like a complete cultural mismatch, doesn't it? But you have to remember the lesson Wall Street learned a few years ago.
With the whole meme stock craze, GameStop and AMC.
Exactly. That retail investors can actually move markets.
Not just move them, they can break them.
Wall Street realized that retail sentiment, what regular people are talking about on forums, isn't just noise anymore. It is a market-moving force. If millions of people on Reddit decide they love a stock, that stock is going to move. Fundamentals be damned.
So big institutional investors realized they had a huge blind spot.
A massive one. But here's the problem. A hedge fund algorithm can't read Reddit. It can't scroll through millions of comments to figure out if people are happy or angry. It needs structured data.
And that is where IC comes in.
That is the product. IC is taking that fire hose of unstructured chat, the emojis, the slang, the hype, and they are using AI to structure it.
They give it a sentiment score.
That's the turn.
So they are literally turning the rocket ship emoji into a number.
Essentially, yes. They quantify the hype, and then they feed that number directly into the data feeds of their clients. So now a high-frequency trader can get a signal that says, sentiment on this stock is spiking on Reddit, and their model can react instantly.
It's professionalizing the chaos.
That is a great way to put it. They're taking the raw, chaotic energy of the internet and packaging it into a neat, very expensive data feed for Wall Street.
That brings us to the infrastructure underneath all this. I mean, processing millions of Reddit comments, plus all the other financial data that takes serious computing power. They talked about something called ICE Aurora.
Yeah, and this connects the bigger picture of AI. Everyone is talking about building AI models, but if you talk to any data scientist, they will tell you that 80% of the work is just cleaning the data so the model can even read it.
So ICE Aurora is their platform that does that cleaning.
They're using AI to clean the data so their clients can use AI to analyze the data. It's the classic shovel selling strategy.
And it is not cheap to build these shovels, I take it.
Not at all. ICE plans to spend between $740 and $790 million in 2026 on capital expenditures. And a huge chunk of that is for AI infrastructure, GPUs, storage, all the heavy hardware needed to handle these massive workloads.
It really shows that they aren't just sitting on their hands. They're actively building the pipes for the next generation of trading. But speaking of pipes, we have to talk about the part of the business that has been clogged for a while.
The housing market.
The mortgage technology segment. It's been the drag on earnings for a couple of years now as interest rates just skyrocketed.
It has. But the tone on this call felt different. They weren't just making excuses anymore. They were talking about green shoots.
And they gave some very specific math about why they're optimistic.
This is the refinance incentive. It's a crucial metric. They noted that as of the call, there are 4 million loans in the money to refinance.
What does in the money mean here?
It means current rates are at least 75 basis points, so 0.75% lower than the borrower's locked rate.
4 million loans, that's a lot of potential business just sitting there.
It is. But here's where the leverage really kicks in. They calculated that if rates drop just another 25 basis points,
Just 0.25%.
that number jumps to 5.5 million loans.
Wow. So a tiny movement in rates unlocks this massive wave of refinancing activity.
And ICE is positioned to capture almost all of that because of their acquisition of Black Knight. They've integrated that massive platform. They're seeing huge synergies. They exited 2025 with $230 million in annualized expense synergies, which beat their targets.
So they've cut the costs and combined the platforms, but they are also deploying AI in the mortgage process in a way that sounds, well, a bit more advanced than just a spell checker. They called it agentic AI.
This is a really important distinction. We need to be clear. This is not just a chatbot that answers FAQs.
What's the difference? I feel like AI agent is the new buzzword.
So traditional automation is linear. It follows a script. If X happens, do Y.
Mm.
Agentic AI is goal-oriented. For example, let's say an underwriter's goal is verify this applicant's income. The AI agent can look at a tax return, realize page 2 is missing, go find page 2 in a different uploaded file, cross-reference it with a bank statement, and then flag a discrepancy.
It's acting like an employee. It's troubleshooting.
Exactly. It isn't just following a track. It is navigating the terrain.
That is a huge shift because usually that stare and compare, looking at two documents to see if the numbers match, is what humans spend hours and hours doing in the mortgage industry.
And humans are bad at it. We get tired, we get bored, we miss things. The AI doesn't. They mention virtual agents that can auto-populate a home equity line of credit application for a consumer.
Oh, that's smart.
Instead of you digging through your filing cabinet, the AI pulls the data they already have and just fills it out for you.
Which removes the friction. If I don't have to spend 3 hours finding documents, I'm much more likely to actually take out the loan.
And for the lender, it reduces the cost to produce that loan significantly. So when that wave of 5.5 million refinances comes, ICE's platform can handle the volume without the lenders needing to hire thousands of new staff.
So we have the energy business booming on volatility. We have the data business pivoting to AI and Reddit sentiment. And we have the mortgage business coiled like a spring, just waiting for the Fed to cut rates.
Pretty good setup.
But there was one more segment that felt very forward-looking. The strategic initiatives.
Yes, the future bets. And we have to talk about the plumbing of the future. The big headline here is tokenization.
Now, usually when I hear tokenization, I think of crypto bros, bored apes, and scams. But ICE was very careful to distance themselves from all that, weren't they?
Very careful. They explicitly stated they're not treating tokenization as a crypto novelty. They aren't waiting for new laws to be passed. Their plan is to seek regulatory approval to trade tokenized securities under existing laws.
So what does that actually look like? If it's not crypto, what is it?
It's about the rails the stock market runs on. Right now, if you buy a stock in the New York Stock Exchange, it takes a day or two for that trade to actually settle.
T+1 settlement.
Right. For the money to officially leave your bank and the stock to officially enter your account, it feels instant on your phone, but in the background, there's a delay.
There's a lag.
There is. But with tokenization on a blockchain, that settlement could be instant, and it can happen 24/7. It basically removes the friction of time from the movement of capital.
But why does ICE care so much? Is it just about speed?
It's about efficiency and capital. If you don't have to wait 2 days for your money to settle, you can use that money for something else immediately. The whole system becomes more liquid. But there's another piece to this puzzle that they dropped.
The U.S. Treasury's clearing.
Yes. This sounded technical, but you're right to flag it as a huge deal. ICE received SEC approval for a new clearing service for U.S. cash treasuries.
And the Treasury market is the biggest in the world.
It is the bedrock of the global financial system. But historically, a lot of that trading happened bilaterally. Just two banks trading with each other somewhat privately.
Which works fine until one of the banks goes bust.
Exactly. And regulators are terrified of that. So they want a central governor of the market to prevent systemic crashes. They want these trades to be cleared centrally.
So a central powerhouse stands in the middle of every trade to guarantee it. And ICE just got approved to be that powerhouse.
They got approved almost a year ahead of the mandate. This positions them perfectly to be the central node for the U.S. government debt market.
It sounds like they are setting themselves up to be the toll booth for everything.
That is the core of the strategy. Whether it's energy, data, mortgages, or government debt, ICE wants to be the infrastructure that it all runs on. They are betting that in 10 years, the NYSE won't just be a place where people shout on a floor. It'll be a digital network that handles every asset class instantly, securely, and largely automatically.
Okay, let's just unpack that all-weather thing one more time before we wrap. We talked about oil and gas volumes, but they also mentioned renewables, right?
They did. This is a crucial part of the hedge. They aren't just betting on fossil fuels. They are heavily involved in environmental products, carbon credits, renewable fuels. Those volumes are growing too.
So if the world goes green, they win. If the world stays on oil, they win.
That's the point. They provide the marketplace for both. And actually, there was a fascinating connection they made between AI and energy.
Oh, right. The power needed to run all those GPUs we talked about.
Exactly. AI requires massive amounts of electricity that increases demand for natural gas and power trading. It's a flywheel. ICE sells the data to train the AI.
And then they facilitate the trading of the energy needed to run the AI.
It's all connected.
It really is. I also want to touch on the mortgage tech competition briefly. They mentioned winning 32 new Encompass logos in Q4. Is that a lot?
In this frozen housing market, yes. It was their best quarter of the year for new wins. And it's significant because there was some concern that after ICE bought Black Knight, clients might get annoyed and leave.
The fear that they become a monopoly and jack up prices?
Right. But winning 32 new clients, including some large players, shows that the platform strategy is working. Lenders want an all-in-one solution, especially one that has that AI automation built in. They want the operating system for mortgages.
And it seems like once you're on the OS, it's very hard to switch.
It makes the revenue sticky, which, investors love.
So looking at 2026, they gave some guidance. Exchange recurring revenues growing mid-single digits. Mortgage tech, low to mid-single digits. It feels steady.
It is steady, but remember the base they're growing from. They're growing off a record year. And they're doing it while reducing leverage. They paid down debt, they bought back $1.3 billion in stock, and they increased the dividend. It's a sign of a very mature, cash-generating machine.
It's the boring compounder that you look up, and suddenly it's up 200% over a few years because it just never stopped growing.
And that is why they emphasize that 20 consecutive years of record revenues. It signals to the market, we know how to grow, regardless of whether interest rates are 0% or 5%, or whether oil is $40 or $100.
It is a fascinating picture. You have the energy business that gets stronger when the world is chaotic. You have the mortgage business that's coiled like a spring, waiting for interest rates to drop. And you have this data layer wrapping around all of it, fed by AI.
It really is an empire of infrastructure.
So here's the question I'm left with. If ICE is successful in moving the stock market to this always-on, tokenized blockchain model, what happens to the concept of the trading day?
That is the big question. If capital can move instantly anywhere in the world at 3:00 a.m. on a Sunday, does the global economy ever actually rest?
Yeah.
And are we ready for the volatility that comes with a market that truly never sleeps?
A sleepless market. That is definitely something to chew on. Thanks for taking the plunge with us on this deep dive into ICE.
Thanks, everyone.
We'll catch you on the next one. Bye.